A Singaporean investor moving capital out of CPF to buy Keppel DC REIT earns a net premium of just 0.55% above the government guaranteed rate. For that tiny fraction, you give up a sovereign guarantee, accept 35.1% corporate debt, and absorb negative 18.8% unit holder dilution. I have been watching this one for a while, and the number that finally made me sit up was the gearing figure. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. 14 stocks screened, 1 survived, 11 failed, and were eliminated before the first table. 2 landed in Zone 4, caution as speculative only, and 1 made it to Zone 3, conditional. Keppel DC REIT. It is not perfect, but in a market full of Zone 4 verdicts, a 7.2 times interest coverage ratio, and genuine AI-driven growth demands a forensic audit, not a dismissal. Keppel DC REIT means something very different to 2 types of investors. For the accumulator, you are building wealth, time is on your side, and growth matters more than yield today. For the retiree in drawdown, you are protecting capital depending on distributions for living expenses, and every single basis point counts. Welcome to the Forensic Lens, where we read the numbers that the headline skips: interest coverage, gearing, and free cash flow sustainability. My goal is to ensure heartland investors get the same clarity institutional money takes for granted. Looking at the financial snapshot, the top-line numbers look solid at first glance. Revenue hits 457 million Singapore dollars on a trailing 12-month basis, passing our internal benchmark with 5% growth. Net profit reaches 433 million Singapore dollars, locking in another pass at 2% growth. But then we hit the red flags. Dividend yield sits at 4.55% against our 5.5% ideal benchmark, registering a fail. Gearing comes in at 35.1%, breaking past our conservative 35% ceiling for another fail. The yield looks attractive at first glance, but then you read the refinancing schedule. To understand how this stock fits into a broader portfolio, let us look at the Iggy forensic zone framework. We grade every asset using 5 distinct zones based on yield, gearing, and interest coverage. Zone 1 is the fortress, demanding a 5.5% plus yield, gearing below 30%, and an interest coverage ratio above 5 times. Zone 2 is the watch list, and Zone 3 is conditional, mapping to yields above 4.7%, gearing between 32 and 35%, and interest coverage between 4 and 5 times. Zone 4 is caution, and Zone 5 is the red zone. Note that Zone 1 and Zone 2 stocks are assessed for CPF and SRS suitability separately, subject to MS and SGX criteria. Every stock gets a forensic zone verdict based on 4 hard metrics: yield, gearing, interest coverage ratio, and soft flag count. This is not a price target, and it is not a buy signal. If you are new to this framework, the full methodology, including CPF and SRS decisions, is covered in our free Forensic Zone Masterclass. Let us unpack our first good point: a fortress-grade interest coverage ratio. Keppel DC REIT delivers an interest coverage ratio of 7.2 times. Compare that to its peers. CapitaLand Integrated Commercial Trust sits at 3.7 times, and Mapletree Logistics comes in at a structural concern of 2.9 times. A safe minimum for me is 4.0 times. Keppel DC REIT clears this by a wide margin, and this is the specific number that keeps it out of Zone 4. The bull case holds completely as long as this ratio stays above 5.5 times through December 2026. This interest coverage ratio creates what I call the distribution shield. The operational interest expense is 15.05 million Singapore dollars per quarter, which operating cash flow covers 7 times over. Even under a severe rate shock impact, the hit to your distribution is just 0.15 Singapore cents, like a kopitiam that earns enough to pay its supplier bills 7 times over. That business is not going under anytime soon. Our second good point is verified AI demand resulting in real revenue growth. The chart shows an upward trajectory from fiscal year 2024 through fiscal year 2025, leading to our current trailing 12-month revenue. This represents 42.2% year-on-year growth from fiscal year 2024 to fiscal year 2025. This is not a slide deck promise. These are real leases, real tenants, and real cash. Our internal benchmark is 5%, and Keppel DC REIT completely demolished it, while Frasers Logistics managed just 5.6%. Even a 10% drop in global cloud spending would impact current revenue by less than 1.8%. This creates a genuine shield for the retiree. For a 62-year-old retail investor relying on stable earnings, this growth proves these assets are highly prized by technology tenants who cannot afford to leave. The bull case holds here as long as year-on-year revenue growth stays above 15% for the next 2 consecutive quarters. Good point number 3 is that we are buying below fair value. The current market price sits at 2 Singapore dollars and 27 cents per unit, while the Investing Pro fair value is modeled at 2 Singapore dollars and 38 cents per unit. This gives unit holders a clear margin. The historical 5-year premium has run at about 12% above book value, making the current discount highly unusual. You are acquiring the AI story at a measured discount. And this is exactly where I pulled that fair value figure from. Investing Pro's model aggregates 4 valuation approaches, and across all of them, the average fair value lands at $2.38. The current price of $2.26 sits below that, upside flagged at 5.1%. The uncertainty rating is high, which is consistent with everything the balance sheet is telling us. This is not a clean story, but the valuation gap is real and it is verified. The financial health scores are worth a quick read too. Cash flow health scores 4 out of 5, profitability health scores 4 out of 5. Those 2 numbers are what keep this in zone 3 rather than zone 4. The operational engine is sound even where the capital structure is stretched. This is the tool behind every forensic audit I run on this channel. If you want to run these numbers yourself before the next earnings window, Investing Pro has a 55% discount available through my code. Link and QR code are in the description. That is the same data, the same fair value models, the same financial health dashboard. The difference is you stop relying on headline numbers and start reading what the balance sheet is actually saying. This valuation discrepancy provides a reliable downside floor. Even if we see a 10% property valuation drop across the portfolio, the built-in cushion limits the damage. The unit price will likely find a hard floor at 2 Singapore dollars and 3 cents, which is the bottom of the 52-week range. The bull case remains intact as long as the market price stays below 2.38 up to the 27th of July 2026 earnings announcement. Now for the red flags, starting with red flag number 1. Your retirement income is at risk before the yield clears our hurdle. Moving capital out of your CPF special account onto Keppel DC REIT earns you just 0.55% above the government-guaranteed 4.0% rate. You are absorbing gearing risk, distribution cut risk, and price volatility for a tiny return premium. Let us look at the yield missed by the numbers. The headline yield is 4.55%, based on an annual distribution per unit of 0.1038 Singapore dollars. My forensic hurdle requires a minimum of 4.7%, which is built from a 3.2% long-term normalized floor plus a 1.5% mandatory risk premium. Looking at peer comparison, Maplet Tree Industrial Trust offers 6.52% and clears this hurdle cleanly. This red flag stays in place unless the distribution yield rises above 4.7% by January 2027. Red flag number 2 highlights debt sitting at the ceiling. Gearing is currently 35.1%, right at my ceiling. While the prior period sat at 35.3%, showing positive direction, the 3-year historical average was a conservative 31.2%. This REIT has permanently shifted into a higher risk debt band. Even a massive peer like CapitaLand Ascenders sits in Zone 4 territory at 42% leverage. This leaves the REIT exactly 1 acquisition away from Zone 4. Current gearing is 35.1%, but after a simulated 10% cap rate expansion, leverage rises to approximately 38.6%. Well past the ceiling, this creates a severe risk of a rights issue, diluting your ownership stake. It is like a family taking on a maximum mortgage just as rates start climbing. 1 more debt-funded acquisition tips the balance. This flag clears only if gearing drops below 34% by October 2026. Red flag number 3 shows unit holder dilution running hot. Shareholder yield has collapsed to negative 18.8% because the REIT is aggressively issuing new units. This is a hidden leak in the bucket. While the 3-year average was a manageable negative 4.2%, dilution has accelerated dramatically. Your ownership percentage erodes with every private placement. The distribution per unit might hold steady, but your actual slice of the capital base is quietly shrinking. This flag clears only if shareholder yield recovers above negative 2% by the fiscal year 2026 full-year results. This brings us to a critical forensic gap. AI demand drives revenue higher, but the capital required to fund that frantic growth is pushing debt past conservative limits. When your debt sits at the ceiling and your yield falls below the retirement hurdle, you are no longer buying a defensive asset, you are subsidizing expensive corporate expansion with your own capital. That is the gap between the headline narrative and the actual balance sheet. And it is exactly the gap that costs heartland investors their retirement income. Let us look at the Singaporean stress test context. The headline yield is 4.55%, while the 6-month T-bill market rate sits at 1.45%. And here is what the arithmetic actually shows. I audit for the storm, not just the sunny day. So I apply a long-term normalized forensic floor of 3.2%. Adding our mandatory risk premium brings our minimum required hurdle to 4.7%. When you run the CPF arithmetic, the trade-off becomes clear. The CPF special account gives you 4.0%, completely guaranteed by the Singapore government. Keppel DC REIT offers 4.55%, giving you a net premium of just 0.55%. For that tiny premium, you surrender a sovereign guarantee, accept 35.1% corporate debt, absorb negative 18.8% dilution, and take on global tenant default risk. For a retiree in drawdown, that trade is incredibly difficult to justify. If reviewing the dividend trajectory, we can trace the historical trend. In fiscal year 2023, the distribution per unit was 9.76 cents, establishing our baseline at a 4.10% yield. Fiscal year 2024 saw a stable 10.10 cents, hitting the 5-year median yield of 4.35%. Fiscal year 2025 crept up to 10.38 cents, and that marginal improvement still lands at 4.55%, which tells you exactly how little room this REIT has before the yield hurdle becomes the conversation. For fiscal year 2026, we must watch the 27th of July earnings announcement for a catalyst to hit our 4.7% plus target. Our peer comparison table summarizes the landscape using verified data. Keppel DC REIT lands in Zone 3 conditional with a 4.55% yield, 35.1% gearing, and a 7.2 times interest coverage ratio. Maplet Tree Industrial Trust clears our yield hurdle cleanly at 6.52%. CapitaLand Integrated Commercial Trust fails our interest coverage floor at 3.7 times. And Mapletree Logistics shows a structural concern at 2.9 times. Meanwhile, CapitaLand Ascendas remains in Zone 4 territory with 42% gearing. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Turning to our community framework, remember that in this market, the difference between a sanctuary and a yield trap is decided in a single trading session. Free subscribers are stuck reading yesterday's story, while Iggy's elite investors are already cross-checking the next setup together in real time. When you join our elite tier, you stop reading delayed news. Iggy's elite investors get 0-day breakdowns with the full forensic picture finalized before the market opens. You get the complete red zone watch list of stocks to avoid, updated every cycle, alongside institutional cheat sheets built for your CPF and SRS decisions. For 9 Singapore dollars a month, less than a kopi and kaya toast at Raffles Place, you stop being the exit liquidity and you start being the analyst. Bringing it all together on our weighing scale, here is the forensic synthesis for Zone 3 conditional. The yield misrepresents a marginal shortfall, not a structural failure. The interest coverage ratio of 7.2 times shows genuine strength and single-handedly prevents a Zone 4 classification. However, gearing remains right at the ceiling, and while it is directionally improving, dilution is running hot. We need one more earnings cycle to confirm whether this asset is truly stabilizing or beginning to crack. Let us look at this for a 38-year-old accumulator. For this profile, Zone 3 conditional represents an acceptable entry point. With a 20-year runway, you can easily look past the short-term yield shortfall. It allows you to capture AI-driven growth at a 4.2% discount to fair value, heavily protected by a 7.2 times interest coverage ratio fortress. The risk is real, but it is entirely manageable for investors with a runway beyond 5 years. For a 59-year-old retiree, however, the asset is entirely unsuitable at current metrics. A 4.55% yield fails our 4.7% baseline hurdle and cannot reliably survive a rate shock or a distribution cut. Taking on a 35.1% corporate debt ratio for a minor 0.55% premium above the guaranteed CPF rate is simply not worth the risk. The clear move here is to wait for the 27th of July 2026 earnings confirmation before committing a single dollar. Reviewing our Iggy classification version 2.7, the portfolio roll split cleanly. For accumulation, it is a pass based on the fair value discount and interest coverage fortress. For transition portfolios, it remains conditional, meaning you should only commit CPF or SRS capital if the yield rises above 4.7%. For drawdown portfolios, it is a flat fail due to the yield shortfall and ceiling level gearing. We are watching the 27th of July earnings closely to track the catalyst. The single tipping factor here is the direction of the debt. The interest coverage ratio buys management time and credibility, but it does not erase a 35.1% gearing ratio sitting precisely at the ceiling. If the next report shows more debt taken on for another acquisition, this stock slides straight into zone 4. Our game plan is disciplined, track the 27th of July earnings. Gearing must move below 34% and yield must show a recovery trajectory before this earns a place in a retirement-grade portfolio. If gearing rises above 36.5% at the next window, does your retirement income floor survive a potential 10% distribution cut? To summarize the forensic verdict, the story out there highlights a massive AI revenue surge, making it look like an unstoppable train from the outside. But the balance sheet reality reveals continuous equity dilution, a yield that just misses our hurdle and debt pushed into higher risk territory. Dividend safety is never created by a good narrative. It is built on a conservative balance sheet. That is not a pessimistic view of this REIT, it is the only honest one. The AI tailwind is real. The revenue growth is verified, but the debt is at the ceiling. The yield misses the hurdle, and the dilution is accelerating. A great story does not change those numbers. Only the next balance sheet will. This makes the stock worth watching closely, but not worth committing retirement capital to until the 27th of July numbers confirm a clear direction. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Stocks flagged as Growth Watch fall below this threshold, but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds. You said, after this strip. Good point number 3 is that we are buying below fair value.